So obviously early days, obviously we'll warn our viewers there's a lot we still do not know. We hope to learn in the coming weeks. But can we talk about to what degree compliance failed here?
Well, compliance definitely had a part in this. And I think it's too soon to say whether or not compliance failed. As a matter of fact, there are some reports that the compliance department at Goldman Sachs actually got in touch with management and said, hey, you should not open this account due to the previous fraudulent activity that was discovered with the associated individual. So they could have made their case and got overridden by the business line managers. And unfortunately, that does happen all too often in our industry. But let's say, for example, they didn't do what they were supposed to do, and that is conduct the initial due diligence on the account during the account opening process, find out who the beneficial owners of the account are, and conduct their KYC, know your customer, and anti-money laundering reviews to determine if there was any previous nefarious activity by those individuals associated with the account. And if they had done that, they would have found that Mr. Huang had previous SEC sanctions against him. And that should have been a huge red flag for the firm.
Right. So how should we be thinking about, or what do you say to those who are worried about the notion that that lure of revenue stream for the equities business at multiple banks was too seductive, and that, in fact, there is ongoing exposure to losses that we may not know about yet?
Right. So the business managers could have said, okay, we're willing to take this risk. We understand the risk, and we're going to take the account. And then in that case, what compliance could have done would be to put the account on a heightened surveillance program, which means that they are taking a look at the account and monitoring it frequently, more frequently than other accounts, and specifically looking for unusual trading activity, looking for high amounts of leverage or changes in types of securities being traded. So anything that could flag out as being unusual to that account, or particularly high margin, high volume of transaction activity, would flag out and then be looked at by the trade compliance staff.
Amy, I'm curious if you think regulators are going to take a much closer look now at Credit Suisse specifically. I mean, obviously, there's the news of the day that we're talking about. But that's, of course, on top of everything we've seen with the Greensill fallout, the fact that the company is now, looking at options for its asset management division in general. There seem to be some fault lines appearing, at least within certain parts of that bank specifically.
Yes, it is possible. I know Credit Suisse has been in the news a lot lately for its asset management division and some of the missteps that have been taken there. And the SEC will look into all of these firms for this activity. And when they do an investigation, they're looking at the firm in general. So it would be their opportunity to take a look at those other instances as well while they're looking at this one.
Shepard Smith here. Thanks for watching CNBC on YouTube.